People are sold too much because there's so much information about real estate, and like you can make a shit ton of money doing real estate, but you're not going to make a shit ton of money really quickly. Typically, you will once you learn the skill set. Like we can go out and do a deal and we're doing a deal right now, we're going to make $2 million on in a matter of 4 months, but that's because we've done all of these other deals, and now we built the skill to do that. So like a newbie hears that and they're like, oh, I want to go do that day one. It's like, no, that's not what you get to do. Yeah, you don't have to be a genius to invest in real estate.
Action is the highest form of intelligence. Like you see, this example, Trevor's doing a deal. They're going to make a couple $1,000,000 in a handful of months. You can't do that today, but in 5 years, you probably can. But you can only do it in 5 years if you buy a deal today.
So they shit the bed. They can't finish the project. It's way over their heads as they're going along. They run out of money. And then they can't qualify for lending, right? Because they couldn't even in the first place. And no lender wants to come in and take on a halfway finished project now. So like they're just kind of screwed. But even on that deal structure, because they started so far in, and I think they bought the materials already and prices have gone up, they still made like $7 million of equity on this thing. And it went so wrong and took 4 extra years than it was supposed to.
Ladies and gentlemen, welcome back to the Saucetown Investor podcast. I am your host, Matt Cox. We are back with another guest today, the first two-time guest in the history of the podcast. Our guest today started off house hacking and transitioned into 160 rental units and counting. It might be more. I had 160 at our last interview. It might be more.
I think I'm at 200 now.
200. Okay, we'll find out how you got there. He also runs a company called Vesta Solutions that helps people get started investing in real estate themselves. He's also been my realtor along with Sabrina in the past. He's kind of a real estate consultant to me. I've learned a ton of real estate from this guy. He's a host of the Deal Junkies podcast as well. I am joined by Trevor Howard. Trevor, what's up, man?
Good to be here. Thanks for having me again. Last time I said I wanted to make it better than Mike's podcast. Do you know if we got a vote on it? I think you posted it and asked which one.
That's so funny you bring that up. Literally before you got on, I was looking back at the numbers. I hate to be the bearer of bad news. You had a lead and Mike has passed you in the long run.
Okay.
So we got to make this one today a banger, and you got to pass Mike in this episode. So we'll make it a good one though.
Cool.
So guys, if you want to hear Trevor's like full story and background and how he grew up and everything, you can go back to the previous episode. Today, Trevor got mad at me last time because we didn't talk enough deals on the podcast. I asked him too many business and other questions. Today, we're going to do some deep dives on some really cool deals that Trevor's been working. But maybe Trevor, still people can go back and listen to your story, but maybe give us a high level about yourself.
Yeah. High level, started buying stuff when I was early 20s, got an engineering degree, realized I came across the FIRE movement, retiring early, doing all that, led me into real estate, started buying houses, rent them out by the bedroom, reached financial independence doing that pretty quickly, and then quit my job, realized I couldn't qualify for anything anymore, and I wanted to do deals still because I was now quit my job to full-time invest. Then I learned how to partner, do creative deal structures, kept learning and meeting with people, learned how to buy apartment complexes, started partnering with others, and kept scaling from there. To today, we now have a partnership where we're doing ground up syndications. We're just doing ground up deals on our own. And then we buy existing multifamily assets. And we own some storage stuff too. So we just have an asset holding company where we're just building and scaling our own real estate portfolio. And then our other company, Vesta, is just helping people do that as well.
Awesome. And we'll be sure at the end of the show to give you a chance to let people know where they can get involved through Vesta, or if they want to invest passively with you through your syndication. So we're going to structure today with a couple big projects. We have a lot of people on here. We have people that do big apartment deals, but we also have people that just do duplex rentals, house flips. We're going to talk some big deals today. One of them You were kind of a fly on the wall for it and have a lot of stories about you weren't directly an owner in the deal. And then we're going to talk about the one that you're currently working on, which you do own a piece of.
Hmm. Yeah, so starting with those deals, so these are on the coastal markets, Astoria and Seaside. The first deal that kind of led us to what we're doing now is through my partner Gabe, who you had on the podcast too. Um, so Gabe he started building this apartment complex like 6 years ago or so, like early on when I met him. He signed on the deal as a 0.02% owner of the deal to guarantee their loan and have the right to buy the deal at the end at a price that made sense for him with terms that made sense for him. So he was like, awesome. All I got to do is sign on the deal. They're bringing all the money. They bring out of the ground. Like they just need my name on the debt so they can qualify. And then I get to own it in the end.
So
And he's
he's
like,
like
yep,
buying.
this
He's like buying. He thinks he's buying an option on it, effectively,
essentially, but they couldn't, they needed his signature to
because he
get
has
it
the
out of
big
the ground
balance
also
sheet to
because
get
he
the
had the
loan.
balance sheet, the
Yeah.
experience and all that. And
Right.
these were first time developers who had spent their whole life trying to put this thing together. And this was a 66 unit deal in Astoria, right on the waterfront. Super cool project. So they're doing this thing, and he knows the only thing, or one of the only things, not the only thing, but one of the main things that can go wrong is hold on, sneeze. All right, never mind. I might let it out halfway through, but so he realizes like one of the main problems is getting it out of the ground. If they can't do that, he's kind of fucked. So sorry, I don't know if we can swear, but you can bleep it
We can
up.
cuss here. Yeah.
Okay. Um, so he realized like as they're going partway through, they weren't properly getting it out of the ground. So they got this thing partially finished, went over budget, over timeline, got in arguments, didn't know how to finish the deal. He got left with this thing, a halfway finished project, and which led us to do what we do now because he met Mark along the way, who owns the construction company we use. And he brought Mark in to actually raise the rest of the money, bring in new debt, and get this deal finished. So the deal turned like it was one of the most stressful things he's probably been through. Like he's like these dudes, they have nothing to lose. They don't care anymore, right? And they have an $11 million loan or 9 million, whatever it was. So he's basically responsible for an $11 million loan on a halfway finished project, and he doesn't know how to bring stuff out of the ground personally.
So did
So
they, Trevor? So did they? Okay, so there's an $11 million loan. These guys have no cash in the deal. Gabe has no.
no, they have cash. So it's
Okay,
probably
good.
like I think it was an $11 million total project at the time they were starting. So they probably had like 3 million, and then remaining
So the
loan
builder
balance.
does have a little skin in the game on this.
The whole group. So they got money in. They've been developing it for they developed it for whatever amount of years. They got the land. The landowner contributed his land too, or something like that, and then the builder contributed money as well, I believe. I don't know the full details, but I think that's somewhat accurate.
Okay, so keep going. We got this
Yeah.
66
So
units that's halfway out of the ground, and what
yep.
happens next?
So they shit the bed. They can't finish the project. It's way over their heads as they're going along. They run out of money, and then they can't qualify for lending, right? Because they couldn't even in the first place. And no lender wants to come in and take on a halfway finished project now. So like they're just kind of screwed and get stressed out because what is he gonna do? So Mark comes in, who's also one of our partners today. He brings in new lending, brings in new debt, brings in some equity as well, invests more of his capital in the game. His construction company comes in and finishes the project just insanely fast and saves the project for all of them. And they get all these other people's money back out. I think they had to do like payment plans or whatever to make it work. Um, but even on that deal structure, because they started it so far in, I think they bought the materials already and prices have gone up. They still made like $7 million of equity on this thing, and it went so wrong and took 4 extra years than it was supposed to. And they had a bunch of fees waived and different things, negotiations with the lenders because they wanted off their books. It was a non-performing loan. Um, but Mark came in, finished that project, and we formed this partnership over time where we're buying all these assets together and building stuff. And we're basically doing that same project, but the right way the first time. In Seaside. So we're bringing another 66 units out of the ground, and we syndicated that deal. And we can dive into details on that because that's one now I own and we've done.
Yeah. Wait. So on the last deal, these guys stop building and kind of flake. Mark comes in, but the deal was like the loan was in default at one point, right?
Oh yeah, they stopped making payments on it. Like, yeah, it was accruing interest and default penalties and all this stuff. So they got to make the deal work and make the next bank take it on, they got like $1 million of fees waived, which a bank will do a lot of the time because it solves their problem too. Like they don't want a halfway finished project.
Yeah, because that, I mean, you think a bank doesn't, they don't even want to own an apartment complex. So
Hmm.
they sure as hell don't want to own a
No
half.
income coming in, yeah,
So you look
nothing.
at a guy like, I mean, the option, of course, like any loan is to go foreclose on it. But
Mhm.
what are they going to do? So you look at a guy like Gabe and Mark, it's like, okay, well, this is going sideways, but who better do we want to try to get things back on
Mhm.
track? Do we want to try to sell it to someone else who's going to pay pennies on the dollar? I mean, I guess they could have. I don't. Gabe, did he personally guarantee it?
Mhm. Oh yeah.
Yeah, so I guess they could go
They weren't
after
going to let that happen. Yeah, so they would have gone after him personally for it, but he
his
was
whole
just working through
portfolio.
solution. And part of the problem was the dudes who were originally in it, because they owned majority, they didn't give him control until they realized like, yeah, we can't physically, like we are not the people for this eventually. And that took like a year or more for them to like give up that control and let it happen too.
And what was their incentive to not? Because I know they had some money in the deal, but so they flipped those guys. So they lost money too, but they were just like, let's cut our
So
losses and
I
go
don't
out.
even think they ended up losing money because they're paying them back over
They
time
had to
on
get.
notes. So I don't, yeah, I don't even think they'll lose money on it. So like they saved it for them too, because they
Oh,
were going to lose everything. Like, and that was their dream. They'd been working on this thing for years and years of developing it, getting it together, and putting all the pieces in place. So, but they were like, they hadn't developed before, and then they went straight into a 66 unit project. Like, I can do that. Like, I don't know like how to do that.
no. So okay, so you get to kind of watch as this all goes down. You're still at the time you're doing your kind of what you've done over and over, right? Buying apartment
Uh-huh.
buildings that are underperforming or need some rent,
Yep.
stabilizing apartments essentially. And you see this happening, and Gabe is just like stressed the fuck out
He
every day.
hides it well
Every,
because he has so
everything's
much going
going,
on. You
yeah,
wouldn't
he's got,
know, but
yeah.
yeah, he's stressed. Like you owe $9 million, and no one else in your partnership can pay it except for you, and you own 2% of the deal, and you can't do or 0.02% of the deal, and you can't do anything about it.
So you see all this happening, and you go, "How do I get in on this?" And so you, so tell
Okay.
why did you want to get in on this? I guess is the first question.
We now had a partnership that made sense with Mark because he is a builder and he does that. Like that's his full time job is bringing those out of the ground, and he knows how to do it, and he just does it on repeat. Then I knew the numbers. Mark also raised capital. Gabe's signing on the loan, and then we have Dane who's also raising capital. And the opportunity was just there. Like we'll do many of these projects at different places throughout Oregon, but like we already own buildings in the Seaside market. We already own buildings in Astoria, and I have another 40 unit in Astoria, and we've been outperforming what we've been projecting on all of them. So we saw the rental demand. Um, so it's just a project that made sense. The land was available. We had investors who wanted to do it. We had lenders who were on board, and it hit return metrics that we were targeting as well for people. And like for reference, like we're trying to target like an 18% AAR. So, and on that specific project, it's build to sell, maybe hold depending on where rates are at. We needed rates at about 5.5%. To be able to refinance it and pull, and people have the money option to stay in at that point or exit. But if rates are at 5.5%, which they are today actually on agency debt with a buy down, then we can potentially hold that deal. So our model on that will have multiple exit strategies.
And you said so. We're going to talk about this next one in Seaside. You said you own a 40 unit. You said that's in Astoria or Seaside.
In Astoria, which is like 15 minutes north, and then Gabe owns quite a few buildings in Seaside, and then we're looking at a couple other projects there too.
How do you handle that? Like, how do you analyze that? Because those are not huge markets. Like, at some point, can you start kind of cannibalizing your own investments there? Because you don't need
Yes,
many doors to serve that market.
the fear would be you overbuild, and there hasn't been a lot of projects built there. So the fear is putting too many units, and now you're lowering rents because you have an oversupply. But there's such an undersupply there that we're not super concerned. And then we feel like we underwrite pretty conservatively because we are underwriting our projected rents similar to our existing value add apartments. So it's like, okay, people are going to live in a new construction property 3 blocks from a beach with a riverfront view, and easily pay what they pay for our stuff that's farther inland than not as nice.
So when you're doing that, are you just able to look at the stuff you already own and be like, we're leasing up really quick, or is there actual, are you
A
using
lot
like,
of it is that, and you can look at market data too and be like, what is the
yeah,
population growth trends over time? How many existing other projects are coming out of the ground? So like seeing how many other units, and then knowing like you can do math and be like, okay, I think the absorption rate will be here, and there's a bunch of data on CoStar as well and stuff like that. Um, for us, a lot of it is market feel. So we're in the market, owning hundreds of units already, in that market, and seeing how quick we're renting that up, what the renter pool is like, what they're paying, and being one of the bigger players in that market is super helpful because you get to see boots on the ground, like firsthand experience of how it's actually going, not just like backwards looking data or forward projections.
So you wouldn't say you've got all this data, but you didn't own, say Pendleton, Oregon, just to use an example, has this data that's like, oh, this is an underbuilt market, rents are good. You wouldn't just do that if you didn't already own stuff there, or would you?
We may not, maybe not with investor capital though. So
Yeah.
that's like two models of like, okay, we are fine risking our own dollars on projects if we have an idea and we want to learn that market and get into it. But we have to be so certain with investor capital that like we wouldn't do it that way. But we would go own in Pendleton for sure. We've offered on buildings in Pendleton. I own freaking 5 houses in Hermiston, Oregon, dude. We
I
we
remember
bought
that
five
story.
houses, yeah, with freaking like 3% down and a 3% rate on a 40-year AM or something like that, just because it was made sense at that time. I was like, we buy real estate with no money that pays for itself. Yeah, I'll do that.
Okay, so we're talking about raising money. Real quick
Uh,
for our listeners, I guess two-parter. Tell everyone briefly what a syndication is, and then
yeah.
talk about what your pitch to investors is when you're calling people or talking to people in the community about a project like this.
Yeah, and to clarify too, like I raised almost no money for this deal. Like so Mark and Dane raised pretty much all of the money. I raised like I would set appointments with them or have people are interested and then kick it to them, and they're really handling all of that. I was more so doing a lot of our other acquisitions, and then on this, I'll look at like our end value. Does this math make sense over the time period? Are these projections reasonable? What is our timelines and diving into all that stuff? But I can speak on watching like Dane and Mark
Yeah.
do it. I've raised some, but so basically, like we can only take accredited investors into the deal. Meaning, if you're an individual, it's like you make over 200 grand a year or something like that, and then you have $1 million net worth, not including your primary residence. And then I think it's if you're a married couple, it's like 300 grand or whatever. But there's a definition for an accredited investor, and then we have to get them certified as well before taking their money. So you can only take accredited investors, and there's like a 506C, 506D, or whatever the different names for the syndications are. One of them, doing it that way, allows us to advertise publicly. So to like we can reach out to people we don't know online and do things like that to get people interested in investing in the project. So that's the model we went for. People curious, it costs like 25 grand to set up with a syndication attorney, and then they review a lot of the stuff. They put together all our docs and look at all that stuff to make sure we're compliant, because we are selling a security at that point. So you're governed by the SEC, and it's like heavily regulated. So if you mess this up, you're in big trouble. So it's a
What
lot
would
different than just doing your own deals.
what was so you said there's two different models you can use. One of
Mm-hmm.
them you're able to kind of or not advertise, but to like sort of cold call people, I guess, or
You
reach
can
out
advertise, yeah.
or
So the other,
advertise. So
yeah,
why
the
would you
other,
do the other one?
so that one, because we can reach out to others. The other one, you can take non-accredited investors up to a certain amount of friends or family or previous existing relationships. And I don't know the exact rules, so yeah, you guys can
Yeah.
literally go on Google or Chat GPT and search this, and it'll tell you in 5 minutes the exact rules. Um, but there's a different regulation like that. Or what you see, what like Grant Cardone does is he crowdfunds, and he takes all, like he can take non-accredited investors, like, and he'll take like a $5,000 minimum in these deals. So he's just mass marketing this thing. Um, and so there's a lot of different models that people use. That one just made the most sense based on what we were trying to do, is our understanding. And we'll probably do all sorts of different things too in the future. But yeah, that's just like we use syndication as just like a tool. Like it's not the way we do all our deals. No deal is the same. It's just a tool. So like we would look at that deal and be like, hey, maybe the landowner will contribute his land forward, and he will basically be who we raise all the money from, and we bring in maybe one other JV partner or just park our own capital. And that would be another way to look at it too. So like every deal is just figuring out all the pieces you need and then how you get everyone what they're looking for out of the deal.
Because in that example, you can use the land as part of your equity, essentially, and the bank will lend against it.
I'll give
Yeah.
you, well, let's talk about this deal. You'll like
Yeah,
this.
please.
People, this will be more relatable for a lot of people too. So I bought a fourplex in Albany years back. It was a $600,000 fourplex, and I was just like, "That's super cheap for a fourplex. This is interesting to me." And I started looking at it, and there was extra land to the side. Um, so I went and bought this fourplex, 100% hard money loan. It doesn't debt cover at all on that, like it bleeds, but I was fine with that because we wouldn't have no money. They took second position collateral on some other stuff I owned as well. Um, but I was like, yeah, this fourplex is worth like 750 or something like that once we fix it up and raise rents. Like, and it's not that out of the shape. We just need to raise rents. But I bought that and then I divided the land off. So I now had a free and clear piece of land, and then I refinanced the fourplex into long-term debt, and then it made sense that way, and I just built an instant equity. I think I pulled money out even when I did that, and now I had this free and clear lot that I did. So me, I don't personally know how to build. I know like the high level and some general information about it. Like you tell me to go build something that's going to take me forever. It's not what I do. So I have this piece of land, and I have my buddy Jaron, who is a builder. I said, "Hey, Jaron, I own this free and clear piece of land. Do you want to partner with me? And me and you can take this piece of land to the bank that's now worth 120 grand essentially. So they view it just as cash. And they will collateralize the land. They'll give us the rest of the money we need to build on it, and we can go from there." So that's something I offered to him, but it's something we offered to these sellers as well, because a lot of these people own a piece of property. They want to see something come out of the ground with it, but they don't have the wherewithal to do it. They don't know what it should be. First off, most people are picking projects that don't make any financial sense. And then they don't know how to do all of the pieces, the loan and all the stuff around it. So we'll be like, hey, like you can stay in the deal and you can exit at different points too, depending on what their goal is. But it's just leaving them in the deal. And it's a better deal for them too, because essentially they become an investor and now they'll get a multiple. So they might have $1.5 million piece of land and they might get $2 million back by the time it's done or whatever it may be. Or like that 40 unit, for example, that was a value add deal. These guys had existing equity in the property. Rather than us finding a money partner who gave us $1 million and partnered with us, they could have just stayed in the deal with us, and they would have made an extra $2 million in 12 months had they stayed in the deal and just contributed their equity to a partnership. And now we go do our value add play. We get our equity pop, we refinance it, pay their money out. Plus they get to own future proceeds and do nothing. Like it's the same idea. You can do it with anyone's equity on any of these properties.
Yeah, I feel like that's such especially the land play. I can see when people own a piece like an actual building, I think there's something in their psyche that they're like, I just want to sell it. But when it's
Yeah.
land, I feel like that's such an easier pitch even than trying to be like, do you want to give us money? Like they have a piece of land that's sitting there, like sure they have
They're not
equity.
doing anything with it. It
It's
just costs them
doing nothing.
taxes. Yeah, and we'll go do all the DD. We'll risk all our money. So if this fails and it doesn't go through, we'll just give you all the plans and we'll tell you what can be done with it still. So worst case, you just have a bunch of new information that you can do whatever you want with.
Yeah, like who could say no to that? I know that because when I was we're not wholesaling anymore, but when we were doing that, we would come upon all these people that own land. They'd always have a like, someday I'm gonna do something with this, and you
Hmm.
know they're never going to do it
Yeah,
on their own because it's such a pain in the ass. But that's what you guys are good at. So they basically get to they kind of not a free ride, like they're contributing their land, but sort of
hmm
do get a free ride to turn it
yeah,
into
and we'll pay appraised value for it too. So we'll just
right.
give you the dollar amount that appraises for, so you get fair market price.
Okay, so did you do that on this Seaside deal then?
Yeah, so that deal is more interesting. You guys can go Google it, and that whole thing was a lawsuit. That was so this dude was syndicating a bunch of stuff or raising money, and he bought a ton of properties. And you can look up Seaside, Oregon, syndication, money stolen or something. It'll probably pop up. There are a bunch of articles on it. But this was a piece they owned, and they had to get out of just cash to start paying back some of these investors. Um, and so that was a little more interesting. But we'd love to do that on as many pieces as possible because then we don't have to go raise those additional funds.
Hey guys, we're taking a quick break, but before we get back into it, If you're enjoying this episode, make sure to like, share, and subscribe. It really helps us to keep bringing you more valuable content. And if you're on Apple Podcasts or Spotify, don't forget to leave a review. Please, it makes a huge difference. All right, let's get back to it. Okay, so let's get into the Seaside deal a little bit, if you'd like. Tell us,
Yeah.
so how, take us to square one, or not quite square one. So you've done your market research, you already own stuff there. You're like, there's the demand for this in Seaside. What happens next?
Yep. So we see the deal. This is just an on-market deal. Dane sees it. He starts looking at it. He's like, this could make some sense. It's listed for 1.5 million bucks or so. It's 2 acres of land. They're advertising as fully entitled and with plans. They didn't have it taken all the way there yet. We started looking at the plans and we were like, all right, this is also just not the highest and best use of the land. They wanted to do like less unit. I don't remember exactly what they wanted to do, but we needed to tweak it a little bit. So Mark figured out what it needed to be. And then we got the plans adjusted and then we go through the entitlement process. This took us 9 months to close though, because the Seaside, this is a small town thing. The Seaside city engineer, or whoever approves it, quit partway through the process. So it was supposed to be 1 month to finish it. And it took 9 because they quit. They had to spend months hiring the next person. The next person had never dealt with anything like this or a project this big. So he had to go hire a third party to give these building permits and like approve them and have them review it. And then there's 6 buildings, so he has to do 6 different permits. And then by the second one, he's like, okay, it's the same thing. Like, I kind of understand now, and I get going. So it took them 9 months to actually, from when we started and went under contract, to get all that and for us to close, which turned out to not be terrible because we were raising funds throughout that whole time. And we had, like, Mark has raised over $10 million, but like, I've never raised money. Dane's never raised money. So it gave us a little more time. But what it came down to is what we've learned is like, we just do the deal within whatever time frame we have almost every single time. So like that took 9 months to raise $4 million. And then we had a deal that we're doing right now that needed $2.1 million immediately after. And they had like 30 days to raise that. And then they did, because they had 30 days and they needed to be done. So it just got done with that amount of time. And the other time they had 9 months to do it. So it took 9 months to do. Which is kind of funny.
Humans, like, that's how humans operate.
Exactly, yeah. So I learned I just need to get us more deals, and then they will figure out where the money comes from if I tell them where we need the money at.
Yeah, it's like the what's that analogy? Like if you put a fish in a small fish bowl, it'll only grow to the size of
like goldfish. Mm-hmm.
Yeah, it'll stop growing or whatever.
Yeah.
So okay, so in. Now you're okay. So it takes 9 months to get this thing in time. Is 60? So you're doing 66 units. Is that the best? Is that the most units you can possibly fit on the piece of land you bought?
Yeah, and based on the mix they wanted to. So that's like I don't know the exact mix anymore, but like 42s and 26 ones or whatever it may be, something like that. And the previous project they did was all ones actually. So we like the 2s better because it's a little different mix. But yeah, so they figured out what the mix was and why and whatnot based on what we already owned there, what was filling, what the housing shortage was like, and what they projected is needed. But like realistically, will you know until it's filled? No, because you're just projecting forward. So they figure out the mix there. Lending was also very difficult in this area because it's such a small market. It's a really big deal for a small market. So it's a weird mix of a lot of people don't want to invest there because of the market, or the deal size is actually too big, and then lenders don't want to do it because the market's too small and the deal is maybe too small for some lenders or too big for the local credit unions and things like that. So this is a deal where it's like, hey, the end value of this deal is around 18.5 million bucks based on like a 6% cap rate and where we're projecting rents and expenses to be at. And then we're going to be all in at 13.5 million. So that's 13.5 million, 1.5-ish, 1.575 or something like that for the land. And then the rest of the equity needed for all the financing and just the equity the lender needs in the project. So that turned out to be around $4 million ish. And then and you need like interest reserves that they make you raise and additional reserves as well.
Say that again. What 1.5 for the land, you raise 4 million more in equity, and then you get, what's the math on that? 8 million.
4 million total equity, yeah, and then 13.5 total project costs. So that's about
9.5 from the bank and 4 in equity.
Exactly.
Okay, got it.
Ballpark there, give or take hundreds of thousands. But So that's where it's at basically. And it took a really long time to find the lending. We were looking for a little higher leverage on the front end just because we could have inflated returns because we have less dollars in, and it made more sense. But no lender would get to that leverage point. We took the loan a couple times to the end, and then we had a loan broker who didn't structure it properly on the front end, and they just wanted to get paid, and they had it set up so
Shocking.
we were going to do the project in phases over like a 4 year span, and we're like, that does not work. We have to get this thing up and out immediately, like out of the ground and done within 12 months is what we're trying to do, not over like multiple years. Like that just kills our return metrics. Like it
Right.
does, the math does not work. And so he took us all the way to the end there, and we kept on, we can't do it now. He's like, okay, no, we got it. And then so it fails right before like the end. So then we got to go restart the process, take that appraisal to the new lender, go through it, and be like, this is what problem we ran into, and blah blah blah. But eventually we find a lender who will do it, right? And then we close on it, and we break ground the same day or the next day. We're like a month and a half in right now, probably, and
Who
we
did you
have
find?
two
Or
buildings framed.
yeah, who did you find, and what was like? Why was
Uh,
what was special about this lender that made it work when everyone else couldn't do it?
they're more of a relationship based lender, and then they saw a lot of our other projects, and they have like up to $500 million in loans sitting with one group, so they were not scared by the deal size at all. They just flew out, they met us in person, and they were like, "We care more so about the operator and your guy because you guys understand the market better than us. So like we're putting a lot of faith in your numbers and your experience more so than other people were just looking at the market. They're like, we care more about the operator is more important to us than the market itself because you guys are the ones putting $4 million in, but you're going to lose first. Like,
Yeah,
so they've just had more success. They felt like vetting operators more heavily than the deal. They're like, you guys know the math better than us on any of these deals that you'll do. Like, so we look at it and we have a team that looks at it still to verify, but we're looking more so at the operator themselves. So they just came through with that. It was we have a debt broker, Sean, and he went and found that for us.
where did they? That's so they flew in. They were in like a different part of the country, and they were like, Seaside, Oregon. We're gonna fly in and check this
Yeah,
out.
they came down to Salem actually. I don't even know if they even looked at the project ever. The dude flew in. They have offices all over. I think he was living in California, and he came and met
Uh,
us at a coffee shop downtown Salem with our whole group, just to meet us before they gave us the loan, and then just asked us. He didn't even ask us about the project at all. He just like they just came to meet us. Like that was it.
That's crazy. So yeah, so you think about a market we were talking about earlier, a market like Seaside that doesn't, it's not a huge market, and theoretically, like it wouldn't be hard to overbuild. On one hand, it feels like it wouldn't be hard to overbuild, but on the other hand, you're seeing how hard it is to get a loan here and work with the city here. So that I feel like yes, if somebody else came in and plopped 66 units down, that would be very bad for you guys. But on the other hand,
Yeah.
no one's going to do that because it's really freaking hard, right?
And there's just a limited amount of land as well to like build there. So like the same as the Willamette Valley and why people like Oregon, all over Oregon, building it's a lot of rules and regulations, and then space wise and zoning wise, there's not. It's not like Texas where you can just build whatever anywhere and
Yeah.
keep going. So it's very limited in the amount of space you can put here.
Yeah, I can't even tell. So I'm in. You probably know Mike's in it too. The group Go Abundance. It's a lot of
Mhm.
real estate investors. I can't tell you how many guys are just immediately like, "Yep, I don't buy in Oregon or Washington because
Mm.
it's hard." And it's like, well, it is hard, but that's part of what makes it good. You get paid to do hard things. I mean, we saw what happened, in Austin, Texas, or what's happening in the entire state of Florida right now, and it's because
Mm.
you can just build like crazy there. So if it's hard to do, odds are you're probably going to get compensated for it.
Yeah.
Did so talk about the city a little bit. Were they like excited to be getting like
Oh, they're
really
pumped.
new
Yeah.
building in there?
They have a housing shortage. They know it. I was surprised. I don't think we did any grant money on. I don't think they did on the Astoria project. I don't think we did on the Seaside project. But I think, I mean, I'm pretty sure Mark looked into it because we talked about it multiple times. But I mean, they're thrilled like that it's coming in there. They want more housing. Like it's very good for their city. It brings like work is happening. It looks nicer. Like it's just a vacant lot before then in the middle of their downtown area. Um, so yeah, they've been super on board with it. I've never talked to them personally. Like that's not the role I
Yeah.
play. But it seems like it's way easier than dealing with like cities like Salem. Like freaking me installing a deck like right now on a property. They're making me like call 27 people just to like do some wild thing that no one knows what's happening about. And I'm like, like, so I'll tell you this, like, so the inspector called something out, so I start working on it. They're like, I don't really know what you need to do, but you need to call planning. And then planning's like, no, not talk to us, call permitting. And then permitting's like, call the inspector. And then you're just going in a circle calling all these people
Yeah,
and no one
everybody.
knows how it works.
Yeah.
And eventually I'm like, hey guys, like, I'm just not going to do anything. You tell me what needs to be done. And then they're like, we'll actually just start fining you. And I'm like, okay, thanks.
Okay. Yeah. This just paying my fine every month is probably worth the time I'll save in not calling all of you 3 times a week.
Yeah, it's wild, like, because it's just a small town, so there's only a few people, so like you can call direct to whoever you want and like, get way more in touch way quicker and get more feedback.
Yeah. So, okay, so you guys have put together this group where you all like you said it yourself. You're like, dude, if I had to build this thing on my own, like it's not my you know how to build, but it's not like your area of expertise. I mean, talk
Yeah.
about, what everyone brings to the table in your group and why it
Mhm.
works to put together a huge project and hopefully more projects like this in the future.
Yeah, you can segment roles. So like I play an acquisition role right now, and I'm more so like I want to buy all of the deals. So like that's what I focus on is just getting these deals. How do we make it work? And then Dane does a lot of capital raising on it, and then takes deals from like I hand it off to him. He makes sure they close. Mark does a lot of asset management and making sure deals operate well, and then brings them out of the ground. And then Gabe is like a money partner balance sheet guy, and he also does acquisitions as well. So like we all want to buy more deals and like know we have different we can all do all of the skill sets too, but we all like doing specific things better, which is nice. So, like it works well together so far. But like we all have a similar goal is the main thing of owning like as much real estate as possible. Um, so it's just like what we all like to spend all of our time doing.
Are you you're on I know you're doing a lot of acquisition stuff like you said. Are you I guess A, are you good at talking to sellers, and B, do you like talking to sellers?
Yeah, I mean, I don't honestly talk to that many sellers. I buy a lot of it through brokers,
Yeah.
and like a lot of it's
I
just
guess I
on
mean broker
market.
when I say seller. Yeah.
Yeah, I mean, a lot of it's just on market, and then a broker's happy to get paid. So like, we're buying deals when no one isn't, and then I'm just like, this is how we would buy it. Here's why. We would buy this 100 ways. So you let me know what you don't like. I want to make it a win-win for you guys. I want you to get paid. And some people are like we're doing a deal right now on a 36 unit, and the brokers are getting in their own ways. This thing's going into foreclosure. Like we are the only option. We are saving the day. This dude is not going to make money. They don't realize they're going to make no money either if we don't end up buying it because they're killing the deal, and they don't get any fees. Because all the brokers are like complaining over like fees together. Like this broker's trying to take this broker's fee and all this crazy stuff. And they don't realize like if they just got out of the way, the deal would have been done and they would have been paid like 3 weeks ago. But they're just like shooting themselves in the foot because like most people don't understand how a deal actually works. Even in the commercial world, like people think commercial brokers are these really smart people. No, they're people who don't own any real estate 90% of the time. 10% of them really, really good. They really understand it. They own some deals themselves, maybe. But 90% of them are just like the same as any residential agent. They don't know anything more. Like it's nothing special.
Yeah, sometimes right. Sometimes you're just like, if you just get out of the way, I'll handle the entire I'll still pay you the same amount. You don't have to do anything. You can just get out of the way, we'll get this deal done. But I think it's kind of an ego thing, right?
Yeah, I don't know what it is. I don't figure out. Yeah, Gabe's way smarter than me, so he handles it better. Where I just don't like to deal with it, so I was not as nice as Gabe. Um, but it's so much easier. Just like we just do it for them basically. Anytime anyone brokers a deal for us, just because it's easier than doing it elsewise, and we just pay them the full fee because we just want to buy the deal. Like we're just like, if we can make this as easy as possible for you, you get paid, seller gets what they want, go find us another deal. Like we'll buy an unlimited amount of these things structured in this way, and you can make. We've paid people hundreds of thousands of dollars in fees, so it's like you can make as much money as you would like based on how many deals you bring.
Do you think a lot of it, because you guys obviously do a lot of stuff like creative finance, seller carry, do you think that's because a lot of these brokers are just in a very like bring a conventional loan, do it the standard way, and they sort of their eyes gloss over when you start talking about all these
It
creative
sounds like
structures.
a hard thing because they have to start thinking or they don't understand, and it seems like
Yeah.
more work to them. Um, Realistically, it's less work because the deal gets closed and they get paid. So like some people are good at understanding that, and other people just not so much.
Hmm.
And brokers want to do different levels of work, but most brokers are lazy. They want to put the property on the market. They want you to bring more money than it's worth and pay all cash. Like that's what they want, but like it doesn't work like that. So they like for a broker to sell a deal and be a good broker, they need to understand who the taker is and how to get that business plan in front of that person in a way that makes sense to them. So it's like, yeah, this is for this type of buyer. This is how much money you can make, and here's all the numbers to support it, and here's how you execute it. And if they did that, it would be way better off. But like development, like no one, they typically like advertise it with no information. They haven't thought through it. They don't know who the end buyer is. So it's really hard to sell. And that's the same with a lot of commercial real estate deals too.
Gotcha. So, okay, so this the Seaside deal is coming up out of the ground now. You're hoping it's going to be completed in 12 months. What are I know there's a ton of moving parts and numbers
We
on this.
underwrote it to like 14 to 16 months. Um,
14.
but like our GC on site gets $100,000 bonus. I'm pretty sure if it gets completed in 12 because it saves a lot of time and he's really good. So and he's
Mark,
done that time and time out. No, so Mark is like high level, but there's another dude on site who is doing a lot of day to day. Um,
got it. And so what are you under what do two bedrooms rent for, like nice two bedrooms like that rent for over there?
oh shoot, I think we underwrote the twos at 1,600 and then the ones at 1,300 or 1,350 or something like that. And those are like I think they're 800 square feet. I can't remember now because it's been a while since we've looked at all of this. Um, but like realistically, we've been achieving way higher, and like on our rehab twos, 3 miles outside of the main city, we're achieving $1,600 rents, and this is like 600 square feet twos with very old, not super nice, like not all these amenities. Um, and so we were kind of basing on a lot of it on our older stuff too, just knowing like we want to outperform this, but we feel confident we can hit this for certain.
And you hit those numbers, you said you're into it for 13 and a half, and it'll be worth 18 if you hit those, but it could go higher if you're pleasantly
If we can
surprised.
get higher too, yeah, and depending on where cap rates are at the time
Yeah.
too, right? So the cool part is Gabe is one of the top apartment brokers in the state and sells these really big deals and is the dude who does it. So he has the best pulse on the market too.
Yeah.
So he knows who the takers are for all of these things too, which is really nice from an end value perspective and knowing like, hey, this guy is the dude who sells all of these projects. So like he knows. So that's
What
helpful
is
too. It's like I'll do the math and Gabe will come up with the same number instinctually because he's freaking done it for so long.
a thousand of them? Yeah. So how do you get a market cap rate for somewhere with that few transactions?
Yeah, I mean, a lot of it will trade because it's a big enough asset, similar to the Valley,
Got it.
but
Okay.
slightly higher cap rate, I would say, on a lot of it. But you're just gonna have fewer takers too at the end. So like people, well, maybe not now because like a lot of people don't want to buy in Portland, and people still like Oregon. So some people will still like it. Um, but a lot of those are different. It's just a different pool, different money going into like an $18 million asset than it is like a $2 million asset. It's just different type of investor.
Yeah,
Like
like
someone
who has
going
the
into
money for
that,
that?
yeah, it's like they'll go buy like, can we sell like because other stuff is selling under six cap, we can probably sell it at six and a quarter cap. I think we projected starting at a six and then we trend upwards like point 0.1 a year, 0.25 a year, something like or not 0.25, but some amount over time will trend up. Um, and like people who would place that, there's 1031 buyers also because multifamily you can trade easier. But a lot of people can borrow cheaper debt than that, so they'll have a positive spread on that cap rate still. And it's a lot of people knowing like, hey, I'm picking up new construction assets like in today's down market at a decent cap rate. I'm not going to have a ton of capex on it, and I don't have rent control for the first 15 years. So that's a big deal as well. So a lot of those people are wealthy individuals parking capital, and they're beating other asset classes that they put their money in, and it just makes sense math wise. Because if someone goes and buys a six cap apartment complex, all cash, like it's a 6% cash on cash return. That's better than any bond or anything else they could get. Plus, they have appreciation on top of that and depreciation. So it's like, oh,
Right.
shoot, I could accelerate this depreciation too, like There's a lot of things you could do on it. So it just outweighs the returns of anything else. And maybe like someone really believes in the Seaside market and sees the upside for rents too, or other things like that.
But
But
it's
we
like,
don't want to sell. Like we want to keep
yeah, you want to keep
it.
it. But your buyer, so that it's like a wealth preservation mode type buyer. It's not a I mean, obviously over long term rents are going to grow up, but they don't need to come in and value
Yeah.
add. They want to
And a lot of
flip.
people can syndicate something like that. That's a deal too, where you'll syndicate and like people will raise money for and buy new construction assets. Like Grant Cardone, right? He buys only A-class apartments that are fully stable, basically. And he's just holding them for the long term.
How do you on something like that, like because it's already stabilized? How do you syndicate that? Take your cut as the GP, and then give your investors a return. That seems very difficult.
Over a long enough time horizon. Like,
Yeah, and good enough marketing if you're Grant Cardone.
mhm. Yeah, I mean, he's just pulling so much. Like, and he's offering like 10 to 12%, I believe, IRR or AR. I don't know what his advertisement is.
Yeah,
Um, like that's not that hard to achieve, just especially because he's doing 10-year holds. So like a lot of it is like you're just guessing what's going to happen. Like you don't know what this thing is going to be worth in 10 years. You have information that helps you predict, but like who fucking knows? Like no one really knows. But he knows like odds are they will hit that over a 10-year period based on what real estate has done throughout the entire history. So it's like,
right.
and then he can just tell people that. And like now they get to go into a stable asset and own this like 0.0003% of an A-class building in whatever state too.
Mhm.
Plus they're like, yeah, I invest with Grant Cardone. Like,
Right. It's the brand. I was down in where were we? Oh yeah, we were down in Miami. And he did you know that he
the
puts like
10X buildings. Yeah, it's
yeah,
fucking sick.
he puts them on. I
Uh
didn't
huh.
realize he does
Uh
that.
huh.
Yeah,
Dude, all over.
he's
He's got so many. He has like, I don't know how many doors now, but insane marketer. Like, he's buying insane buildings, that model.
yeah. Okay. So do you have time to talk one more deal?
Yeah, yeah, for sure.
Cool, let's hang. So okay, so Seaside, we'll look for that coming, hopefully going live in the next 12 months or so. This 36 unit, share what you can. I don't want to get you
Oh,
in
we can't
trouble.
talk about that yet. We can talk about that in like a week, hopefully, or two. But,
Okay, do
no,
you have another deal you're working you want to talk about or that you just closed on?
we can talk about deals we've closed, or we can talk about live deals. What type of deal do you want to hear about? Like raising money on a deal, or like
Yeah,
creative
maybe
deal, or just conventional deal?
wherever you want to take. Maybe another syndication deal you're working.
hmm So like we're not doing any actual specific syndications right now, but we're doing partnerships on a lot of
Yeah.
these deals where we'll bring in individual money partners. Um, we're working a couple, so I'm working a 70 unit, a 36, and then 115 units right now.
Let's do the
Um,
115. Let's go big.
Oh, shoot. We learned our lesson on deal junkies from
Okay,
talking
okay.
about live deals.
Yeah,
We
yeah.
lost, I'll tell you that, we lost a deal one time because our podcast was a month delayed. And I was talking about how I didn't like this deal and it was a shit deal. And we were like a week before closing and the appraiser listened to that podcast episode. And, and then they talked to the lender and they didn't like our podcast episode and canceled our loan. And we had to go start the new loan process with
Did
another
you
bank.
But you didn't like the deal, but
Well, I didn't like it at that time. I liked the deal in the end once I thought through it more and we structured it differently. But at the time, like that wasn't accurate information on the deal that I was talking about, or like the information changed and it was just 30 days to release like later too. So like,
I see. Okay, so you were kind of like still
yeah,
you
it was
weren't
back what we
sure.
thought about the deal 30 or 60 days ago or whatever. And like before we structured the debt and before we negotiated and before we did all this. And the funny thing is the dude still overappraised what I said it was worth on the podcast too. So I was like, yeah.
Did did he like how do you know that he listened? Did he tell you that he's like, "Hey,
Oh,
I
the
heard your
bank. There was only
podcast."
one person. He said someone who went out to the property, listened to the podcast, and we don't like this, and this thing. I was like, oh, there's only one person who goes out there, and that's the appraiser. Like, and then
Oh.
they just said nothing. I was like, all right, cool. I was like, I know who the appraiser is. They sent us the appraisal. Like,
But then the appraisal came in low, the lender.
appraisal came in high actually, but they didn't like how we were talking about structuring the deal because we were thinking
Oh, I
about
see.
going a different structure on the front end with a second on the property, and banks don't like seconds, and they're like, we heard you guys talk about how you're going to put a second. I was like, yeah, I was brainstorming how we could do this deal if we go with a different bank. but that's not how we structured this one. And they couldn't get it through their head, and they just can't. So I called the next lender. I was like, hey, they listened to our podcast episode. They didn't like this. Can you do the loan? And they're like, yeah, they actually just probably don't have money to lend to you anymore, and they're using that as an excuse. And I was like,
I
yeah,
see.
okay, cool, that makes sense. Because like we called them and we are like, what like tell me what the issue is. Like, what is the specific issue so we can overcome this objection? And they would just not have anything. So I think it truly came down to like they over levered how many multifamily loans they gave out and then didn't realize it. And then that was a big portion of it.
It's funny how many that applies to so many things in negotiation and real estate, whether it's lender, buyer, seller, they're whatever reason they're giving you, it probably is just about money at the end of the day. They want
Yeah.
more money, that's or they don't have the money, or it all comes back to money. It's not actually because of the thing they're saying.
Yeah. So now we wait to talk about our deals until after they close because dude, that sucked. That was 3 days before closing till we got that phone call, and we were just like, God damn it. Um, but shoot. So as far as other deals, I can talk about general deal structures too. I'll tell you about one deal. Okay.
Yes.
It was at this moment that he knew. He fucked up.
Yeah, talk about we kind of covered this the first time you were on, but it was really interesting. I think we put it on our Instagram and it went got a ton of reaction to it. Talk about your sort of mindset or thesis around debt and why you're not because people look at it. I mean, I did it before I started working with you guys. We're
Yeah.
like, wait, you're leveraging that much on it? Like that sounds
Hmm.
really reckless. It sounds risky, and it is risky on some level. But
Hmm.
talk about why you do that, and why you don't think it's frankly that risky.
Yeah, so I want long-term fixed rate debt on basically everything I buy. This doesn't apply to every deal. Like sometimes we do take short-term debt and it still makes sense for that deal structure, but majority of the time, I want long-term fixed rate debt from the get-go, or I want to get into long-term fixed rate debt. And my theory on that is if I can get 10-year money, and we do take 5-year money a lot of time too. But if I can get 10-year money throughout the entire history of real estate, it has never dipped over a 10-year period, and you're going to pay down, depending on your amortization schedule, like 20%, 22%, something like that, of your principal if you have just like a 75% loan. So if your real estate does not go up in value by $1 over a 10-year period, you can add another 3% into the deal and refinance the deal and be safe still. So like that's insane. Like it's a crazy to assume. Like I personally think it's crazy to assume it won't go up by $1 in value over 10 years. Like I think that's more unrealistic. Um, so like to me, that seems super safe. Like I'm not even banking on this to really go up necessarily, and I can still make this deal work. So I mean, that's my theory. Like I just like doing long term fixed rate debt because I feel like it reduces risk. So like beginner investors, you're getting 30-year fully amortized loans. Like that's so safe. Like you just have to be able to hold the deal, and if it can pay for itself, you're set, and that outperforms the returns on anything they could do. If I did this early on, so I would look because I was investing in the stock market, so I would do opportunity cost of all the different investments you could make and figure out what's best. If you go and you take 20 grand and you put it in the S&P 500 and assume whatever a 10% return over time, or if you take 20 grand and go put it on a $500,000 property and your property does not go up in value by $1, your return on that house is still higher than the S&P, which is insane because you're going to have the cash flow on a free and cleared paid off property and the loan pay down on it. And I don't even think I was thinking depreciation at that time either. Um, and that's just, I think I was doing that assuming like rent doesn't even go up either. So it's insane to like be able to do that when realistically, like in 30 years, that property is going to be worth like what 5x of what it's typically like 7 to 12 years. You'll see real estate double over like looking backwards. So to me, that's
Yeah.
just crazy. Like you can't do that with anything else.
Well, and there was, I remember you said something too where it sort of clicked for me. Like just to use round numbers, say you're buying $1 million asset. Why would it be less risky for you to put 200K of we'll say 250K of your own money in it and 750K of the bank's?
Mhm.
Why is that less risky than putting 750 from the bank and 250 from a seller
Yeah,
carry?
so it's an interesting thought process of like, what is risk at that point? Is it more risk or less risk to have your own money in the deal? I would think it's more risky technically to have your more money in the deal, your own money in the deal. But it might be less risky in other ways because it's better to lose your money than other people's, right? So it's depending on what you consider risk. But like, yeah, it totally can make sense to do. And if you're buying real estate with less money, you can buy more real estate, which it's good to own more real estate. Like a general, like super simple high level, own more real estate. It'll be good for you. Um, it's
Yeah,
just
there's
figuring out
something to
how can I
be.
do that and how does it make sense for my personal situation. But
Yeah, and to your point, I mean, there's something to be said for being a responsible borrower too. Like if you take somebody's 200 in that scenario, somebody's 250, like don't be an asshole and have when the 10-year timeline arrives and have nothing to your name or don't have the
yeah,
and there's always some risk. Like we say like have your portfolio equity, like the market can it's not riskless, but we all know what it means to like take somebody's else's money seriously and be ready to pay it when the maturity date
yeah,
arrives.
you have to have a business plan and a way to do so, or like they're an equity partner and they understand the risks of the deals too. Like, so I've lost a shit ton of money investing in real estate. I've had like a quarter million stolen from doing that same thing. I've lost money on personal deals. Like, I'm able to see a lot of these things, and I've talked to a lot of people who've also lost money. Like, if you talk to investors who have done this a long time, they've all lost money on different deal types. Like, you've probably
Well, like,
lost money too on deals too. Like, but it's not. It's just the cost of playing the game, and like, did you actually lose money? So like that's the thing of why I like the long term fixed rate debt. So these deals I lost money on, I didn't actually lose money. I just had to invest more capital than I originally thought on the front end. Like I bought a $7 million portfolio. I had to put hundreds of $1,000s into it. Like I'm still going to make millions of dollars. It just sucked on the front end because I was off by whatever 300 grand on my budget originally. So I had to invest another 300 grand into it. But did I lose that money? Like for the short term, sure, but not. I didn't really lose it. I invested additional capital, so it's just your mindset around it a little bit. And like I'm not saying you can definitely go out and lose money and do bad deals, but I think people tend to be a little bit on the other side. Like they're more worried about that than they should be a lot of the time. Like understand the basic math. Does it align with your current risk tolerance and your goals? And if so, do the deal. Like you will not find a perfect deal ever. And your skill set will improve over time the more deals that you do because you're going to learn more. It's just like anything else. So like for people listening, if they want to invest heavily and do more deals, you have to start doing deals. Like,
yeah, that's it. I'll do one more. I know you probably got to get out of here soon. I
oh,
actually it
I'm
was
good.
on. It
You can
was
go however long.
okay. It was on. Actually, it was on Deal Junkies this morning. Another kind of like mindset shift thing that I learned from working with you guys is the idea. And I'm not saying everybody should go out and buy cash flow negative properties today if it's your first deal, but you can buy them a property that might not cash flow the first couple of years. And it was a really, I can't remember if you said it or if Gabe said it or, but say you have a property that is cash not loses that's cash flow negative $300 a month for the first year.
Mm-hmm.
If somebody threw $300 a month in their 401k, everybody pats them on the back for it and says that's awesome, that's great that you're putting money away.
Yep.
So why is the mindset different around real estate? And that, of course, with the disclaimer, you need to buy a deal.
Yeah.
But why is that any different?
People are sold too much because there's so much information about real estate, and like you can make a shit ton of money doing real estate, but you're not going to make a shit ton of money really quickly. Typically, you will once you learn the skill set. Like we can go out and do a deal and make. We're doing a deal right now. We're going to make $2 million on in a matter of 4 months. But that's because we've done all of these other deals, and now we built the skill to do that. So like a newbie hears that and they're like, "Oh, I want to go do that day one." It's like, no, that's not what you get to do. And what people realize is like throughout all time periods of real estate, because rents and prices go together typically and interest rates, they all interact together and you're pretty much doing the same thing a lot of the times. Like there's pros and cons to every cycle. Like when rates were really low, you were paying a shit ton for these properties and it was really hard to buy them because everyone had money, right? So like there's different challenges in every market, but like people get stuck on like they don't realize like every deal you buy with 95%, 97% leverage loses money day one, pretty much throughout all time periods of history. It's not just a now thing. Like you're not going to go put 20 grand down and cash flow 20 grand a year day one, like on a
Yeah.
rental. Like you're acquiring a $500,000 asset with 20 grand. It's the most insane thing. You can't do that with any other asset type. So like you investing that money, it then comes down to like a personal situation. For high income earners, $300 a month, they're like, yeah, this makes a lot of sense. My freaking appreciation alone is worth this. My depreciation alone is like worth this to me. It's like, but for the beginner, it's like, holy shit, I make 50 grand a year. Like that is a lot of money. That's the person who really needs to think about it. And like, is this worth it to me right now? Or how do I make it so? And over what time period does it bleed? And how do I make it not bleed? Or can I get more creative with this deal so it does cash flow day one? So like when I started out, I only understood cash flow. I didn't understand depreciation, loan pay down, appreciation, any other ways you make money in real estate. So I was just looking at cash flow. Had I gone back, I would have way rather bought a fucking $1 million fourplex than a $400,000 home that lost me $300 a month starting out, because I would have made way more money on that over time than this house that cash flowed me 800 a month or whatever it was when I was renting out by the room.
Yeah, if you've got like a high paying W-2 job that you're only, and you're our age, the only thing you should really be worried about is long-term appreciation. You don't need to go buy, and I don't know if you've done it. I've fallen into that like I bought a place in the Midwest because it like
You
cash
thought
flowed
you
a bunch
cash
of
flow
money.
more.
It's
Yeah.
really cool.
But you realize it doesn't actually cash flow more a lot of
yeah,
the time because there's higher expenses and all these other things.
yeah, exactly.
Uh,
It's fool's gold for sure. It looks really good on an Excel sheet, and it makes it, and there's something to be said for a lot of people, like myself included. You buy cash flow because it helps get you out of your W-2. It helps you
mhm.
replace your
Yeah.
income. But if you're not trying to get out of your W-2, you don't need to replace your income. You want to have a ton of money in 20 years or 10 years or whatever. You don't need to make $200 every month. It
Yeah.
doesn't
And if
change.
you think about it, it doesn't take that long too. Because like a lot of these people, when they're looking at their deals, so this is specifically the beginners. Like if you own less than 5 deals and you should be house hacking. And what I mean by that, owner occupied loans, you put a little bit down, you live in a property for a bit, move to the next. If you don't want to live in the property, you can partner with others. Like there's not really excuse to not do this. But they're just looking at the deal and it's like, okay, can I personally, am I willing to invest that $300 a month? And is that cash flow number still only principal? Because if it is, you are just putting money in a savings account at that point. And then you want to look at over time, what does that look like? So you may start with like negative 10 grand year one, then negative 5 grand, then break even because you have way below market rents. And that's fine. You just need to understand what that looks like. And like, can you physically support that amount of money over that period of time? And that could still make sense for your investment portfolio. All this to say, like, you can also cash flow on a deal day one. It's
Totally.
just a different type of deal. And you may actually make less money on that cash flowing deal over time than this other deal. And it depends. Like there's no right or wrong. It depends on what the individual's goals are. So if you're broke and you can't afford that, and you may have to buy a cash flow deal to start, and like, yeah, go for that. That's great too. Like it's more so like an individual thing, but people just get stuck thinking like, if this has any negative cash flow, I won't buy it. And like realistically, like if like especially beginners, because they're putting like 15 grand down, it might be negative 3 grand cash flow year one because it's below market rates, then break even or whatever. And if you told them like, hey, so they'll pass on those deals all day because they see the negative number. But if you told them, hey, rather than 15 grand down, you put 20 grand down, but you break even day one, would you do it? They'd be like, oh yeah, of course. And it's the same thing. It's the same thing in the end.
Yeah, and the alternative is, it's a $500,000 asset. Would you rather put 100 grand down and then you cash flow day one, or
Mm-hmm.
you could be cash flow negative? If when you switch your mindset, you think of that 10 grand you lose year one, the 5 grand year two. That's your down
Yeah.
payment.
Mm-hmm. The problem you run into is if you do too many of those at once,
Yeah,
past your personal bandwidth, then it becomes a problem. But if you're making whatever 100 grand at your job and you're negative $1,000 a month cash flow on your whole portfolio, who cares? It's $12,000 a year. Make sure you still have reserves, right? There's other factors that go into that. But if you have upside, you're increasing rents over time, you can totally do that. It can make sense for you personally. A lot of people, that's not why they get into it. They want the cash flow, and you can, again, cash flow on deals. But I think people just turn down so many deals that make sense because they start out looking like bad deals, but you can improve them over time and make them into better deals.
yeah, and like you said, underwrite the repairs and vacancy. Don't just do,
Mhm.
take the PITI or to take
Yeah.
track
And
PITI.
so like, that's the other thing is most people are looking at deals as beginners and they're like, this is what it runs for. This is my PITI. It's like,
Yep.
no, but honestly, like you're better off looking at that deal because it'll get you into a deal and you'll buy a deal and
Yeah.
you'll make money over a time. So like, if that's what you got to do to buy it, like go for it. But that's not how your numbers are going to actually work out. So like part of it is like our underwriting is more conservative. We're baking vacancy and management and repairs and maintenance and like utilities and all these things that people don't think about. And then once they start thinking about those, they get scared. Rather than if they just did it the way they were thinking on the front end, they would have bought the deal and then they would have realized later and then they would have figured out how to pay $300 a month because they're not going to just not like and lose their house. Like it's $300 only. It's nothing. Like they spend $300 probably in useless subscriptions every month on random shit.
Exactly. Sometimes it's beneficial to kind of not know what you don't know. And I mean, we talk about this so much with everybody I have on this podcast, but like
you don't have to be a genius to invest in real estate.
Action is the highest form of intelligence. Like you see this example. Trevor's doing a deal. He's making, they're going to make a couple $1,000,000 in a handful of months. You can't do that today, but in 5 years, you probably can. But you can only do it in 5 years if you buy a deal today. You're not going to wake up, but you have to get the reps. You have to buy a duplex. You have to buy, whatever. It doesn't matter what the deal is, but you got to buy something. You got to start learning the game because you're not going to wake up one day and just know how to do it.
Yeah. And if like, do a lot of people listen to this, are they new or do you know like the demographics kind of it all?
I don't. I do not know. I think our main demo is like 20 to 38.
Okay, that's probably like us too. So if you're new and you're listening to this and you own less than 5 deals or own no deals, like you should set the goal of owning like 3 deals over the next 3 years. Super attainable. Like, and you will easily do it. Anyone can do it. 100% of people can do it, and you will change your entire life just from doing those first 3 deals. That you're all going to do it different ways. Easiest way to start is through house hacking. Lowest barrier to entry, least amount of money. It's easiest. Like if you can do that, I would just go get 3 deals under your belt, and like that's what I did basically. And you will probably take it way past that, but just doing that first stepping stone starts to give you the confidence and teach you the basics.
Yep, you'll turn into a deal junkie very quickly. Once you get addicted, you'll do a few of them. So, well, that is a great note to leave it on, Trevor. Before we let you go, tell people where they can follow you, and then also tell people if they want to learn how to own real estate through Vesta Solutions, and also want to invest passively with you guys through your syndication.
Yeah, if you guys want any of that, you can follow me on Instagram, Trevor Howard, THOW5, THOW5. You can DM us there. You can look up Vesta Solutions. And if you want to invest capital, you can just DM us there and we'll get you to the right channels. But just follow me on Instagram and you can shoot me a message. We'll respond to you. Good stuff. Well, thank you, Trevor. Everybody, if you're listening, share this one. We need to make sure Trevor passes Mike Nuss in total views on the Saucetown Investor podcast. So thanks, Trevor. Appreciate it. Yeah, man. Thanks for having me. That is a wrap for today's episode. Thanks for tuning in to the Saucetown Investor. If you got value from this, drop us a comment and let us know your thoughts. Did you have a big takeaway? Is there a topic you want to see us cover next time? Is there a guest you want to see interviewed? DMs are open. Business is at Saucetown Properties, and my personal, you can DM me personally, is at the Real Matt Cox 4. We'd also like to ask you kindly to please like and subscribe. You can also follow along with the Saucetown Investor blog. That's mattcox444.substack.com. Thanks again, guys, and until next time, keep investing and stay saucy, Saucetown.